Hi everyone. Let's continue with the concept of branch accounts. In the branch accounts, what we discussed is that what we understood the meaning of a branch, and then we understood what is the difference between branch accounts and departmental accounts. Then we saw what are the classification of branches. Then we understood about dependent branches. Dependent branches are those branches where the business policy and administration of the branch are wholly controlled by the head office, and its accounts are also maintained by the head office. Okay, and then we saw about three methods, right? Like stock and detached method, final accounts method. Before that, we understood that goods can be invoiced at the branches at either at cost or at selling price, and in the case of retail branches, it can be at a wholesale price. Then we saw the journal entries for each method and each basis of accounting, and then we discussed about the manner of treatment of rebates and allowances. Treatment of rebates and allowances. Rebates and allowances will be debited to P&L and credited to the customer's account, right? Then elimination of unrealized profit in the closing stock is very necessary to eliminate the profit from the closing stock by creating the branch. Either by debiting the branch assessment account and the crediting the stock reserve account. Or the alternative method will be like we'll close the branch stock account and the goods and the branch account. Whatever the net closing balance is there in the goods and the branch account will represent the net sales, and we will introduce the closing stock directly in the trading profit and loss account via a journal entry. Then these were the things, and then we moved on discussing the accounting for independent branches. Independent branches are those branches where the policy is also governed by the branch itself, and the books of accounts are also maintained on a double entry system in the branch itself. Now, also we discussed about the adjustment and reconciliation of head office and branch accounts. This will be there only when there is independent branches. What are the reasons of disagreement? It could either be the goods dispatched by the head office not received by the branch, or goods returned by the branch but not office to the branch, or vice versa. Receipt of payment or receipt of income or payment of expenses or relating to branch which has been directly paid by the HO but not recorded in the books of branch. And we also discussed the other points which are to be discussed, right? Like adjustments are made only at the point where the recording has been omitted, or and other point where action has already been effected. Now we are going to discuss the other points. Okay. Other points starts with the interbranch transactions. Interbranch transactions are usually adjusted as if they were entered into only with the head office. It is a very convenient method of treating such transaction, especially when the number of branches are large. If number of branches is large and we are transacting, each branch is transacting with every other branch, then maintaining a large number of accounts and reconciliation will be very much trouble. So whatever we are going to do, we will put it as head office, and head office will maintain each branch account, right? There they will adjust the net they will pay. Okay, this is what interbranch transaction would mean. Then moving on to fixed asset. Often accounts of the fixed assets of a branch are kept in the head office books. In such a case, at the end of the year, the amount of depreciation on the assets is debited to the branch concerned by recording the following journal entry by the head office. Branch account debit to branch asset account. Okay, the branch will pass what entry? Depreciation account debit to head office account. Since the asset is in one book and depreciation is other books, we are maintaining this type of journal entry. Then, head office expenses charged to branch. Usually, the head office devotes considerable time of its time in attending the affairs of the branch. Right, for that they will charge the branch certain amount of labor charges. Okay. In such a case, the amount is being debited to the branch and is credited to the appropriate expense such as salaries account, general charges account, entertainment account, etc. The branch credits the HO and debits the expense account. Like we had this entry, right? Depreciation account debit to head office account. Like this, for these expenses, what is it? Expense account debit to head office account. And here, what it be? Branch account debit to corresponding expense account. For example, it can be salary of an employee. Okay, a manager of the head office is also okay. But in that case, what is the entry that will be passed is branch account debit to salary expenses to that extent of time which has been devoted to the branch. Okay, say for example, 1,000 rupees. Okay, now in the branch books, it will pass an entry salary of manager account thousand to head office account. Now, incorporation of branch balance in head office book. The method that will be adopted in incorporating the trading receipts of the branch with that of the head office will depend on whether it is desirable to prepare standalone P&L and balance sheet for each branch or consolidated statement of branch and HO. Okay, standalone P&L, then each books of accounts has to be closed, right? Each branch books has to be closed, and then P&L, trading P&L has to be prepared, and balance sheet has to be prepared, and this will be shared with the head office. On the case of consolidated statement of branch and HO, all the ledgers will be closed by transfer to HO, and that will be correspondingly opened in the HO books, and then the consolidated statement will be prepared. Method 1. Separate P&L and balance sheet for each branch. Amount of P&L is shown by branch and is transferred to HO in branch books, and converse entries passed in HO books as and then the branch balance sheet would show the amount of advanced by the HO to it as capital, and in HO books it will be like advance to branch, okay, or advance from branch. Either way, if capital is debit, then it will be advance from okay, branch. Then, method to prepare a consolidated profit and loss account. Individual balances of all revenue accounts will be separately transferred to the HO by debit and credit in the branch books, and converse entry will be passed in HO books. Amount of net profit or loss having been transferred, since it's composed of the balances that have been transferred. What is net profit or loss? Nothing but the difference between all sort of income and all sort of expenses. Right now, we are transferring each and every income and expense separately to HO books. Now, all the profit and loss elements already transferred to the HO books. In case it's also decided that the balance sheet of the branch will be prepared, it will also be necessary to transfer all the balance of assets and liabilities to that of head office. Okay. Now, the adjusting entry that will be passed in respect of the books of the branch as shown as below. Head office account debit to asset, liability account debit to head office account. Converse entry will be passed in head office books. That is asset account debit to branch account, branch account debit to liability account. It is obvious that aforementioned entries have been passed. The branch account in the head office books and head office account in the branch books will be closed, and it will be necessary to restart them at the beginning of the next step, because branch and the everything is being transferred now, so the entire account will be closed. Okay, if and now every year we have to open a new branch account. In consequence, at the beginning of the following year, the undermentioned entry is recorded in the branch asset account debit to liability account to HO account. This is the branch balance. Okay, now incomplete information in branch books. If it is desired, the profitability of the branch should be kept a secret from the branch staff. The head office would hold some key information from the branch. Some key information from the branch. Okay, the head office in this case would maintain a record of goods sent to branch account by passing journal entry. If we are thinking, okay, what happens is that in the case of companies, they would pay a performance bonus. Okay, that will be linked to the profit. Okay, if all elements, or if they it is at the right of the branch to P&L and balance sheet, then they will be knowing what is the exact profit earned. They will be expecting some sort of performance bonus. Okay, budget cannot fit into, maybe, right? So that's why it happens that certain important key figures will be kept as secret. Okay, one of such figures is the closing stock, opening stock, and goods and branch accounts value, not the stock count, because they possess the stock, so stock count cannot be manipulated, but the value will not be disclosed to the branch. Okay, now goods supplied to the branch purchase account. This will be the entry will be passed for maintaining. Okay, for this goods and branch account, which was there, this will be there in the head office books. Okay, the value in the closing stock will be adjusted only in the head office book. It's a case for closing its books of the year, the end of year. The branch would simply transfer the various revenue account to head office, drawing up the trading profit and loss account. Standalone PL will not be paid. Like we do in consolidated method. Every revenue accounts will be transferred to the head office. On this basis, supplemented by the record of transaction at the head office, it will be possible to consider trading profit and loss account of that branch with by the branch, and then the stock details. The head office will prepare the branch profit and loss account. Okay, foreign branches. Now that we all discussed about the domestic branches, we had a categories of dependent and independent branches. Dependent branches are those branches where the accounting records are maintained by the head office, and independent branches are those branches where the accounting records are maintained by the branch itself. Okay. and there could be problem of reconciliation, right? And then it can also be there where the head office need not disclose the stock value to the branch so that they will not be make ending up with arriving at the net profit, right? They will not arrive the net profit figure. So that may be a case. That's why they have introduced this method where all of the revenue accounts will be maintained by the branch. So then at the end of the year will be transferred to the head office, and stock credit account will be maintained at the head office, which will also be used by preparing the profit and loss account of that branch. Okay. Yeah. Now moving on to the next one. So for can we maintain independent and complete record of business transacted by them in the currency of that country in which they operate, because they're in foreign, they have to also comply with their domestic laws and regulations, right? Their domestic laws and regulations will every country will require their business organizations to maintain a Okay, that's why there will not be a case of dependent or independent branches. All things will be in independent branches only. Okay. So what happens is that they will be maintaining every set of records independently, and all the completeness will be the complete records of business will be okay. Thus, problem of incorporating foreign balances of foreign branches related to mainly with the translation into Indian rupees. We have to translate that all the records are made. Okay, is it possible to maintain our records in USD and submit it to government? No, we have to maintain in INR, right? Likewise, for a company in somewhere like China's, they have to make China, they have to maintain in yen, right? They have to maintain in yen, and at the end of the year, for the purpose of consolidation, we have to bring that branch also for the purpose of consolidation to the head office. So in that case, there will be a problem of conversion of foreign currency. Other than the reconciliation issue, we now also have an issue of conversion. Okay, because the exchange rate, because exchange is not stable, right? What is the rate of 1 USD to INR in 1st April 2022 will not be equal to the rate of INR that will be there on 31st March. Okay, that's why there is a this is because exchange rate is not stable. This is also due to the international demand and supply, which is affected by the supply. The accounting principles which apply to Indian branches also apply to foreign branch after converting the trial branch of Indian foreign branch into Indian currency. So as long in USD, the accounting principles cannot be applied directly, right? We have to apply an conversion rate and convert the foreign currency amounts into INR, and then we have to check whether all the accounting standards have been complied with or not. Now, for the purpose of accounting, AS11 classify the foreign branches into two types, because AS11 is standard which deals with forex rates, right? So that standard has classified the foreign branch types. Okay, what are the two types? It is foreign operation and non-integral foreign operation. We call as IFO and NIFO. IFO and NIFO. IFO and NIFO. Okay, IFO and NIFO. Info and NIFO. Right. Okay. Two types of foreign branches. Integral foreign operation is IFO. It is a foreign operation, the activities of which are integral part of those of the reporting enterprises. All the activities are interconnected, integrated. One and like it is like we used to have this saying, right? We are only two bodies, but one soul is one. Like that. There are two different two different entities as branches and head office, but they operate in a only single manner, as so integrated. The business of IFO is carried on as if it was an extension of the reporting enterprise operations, as if every decision will be taken by the head office. Just the mere implementation will be there in the branch. For example, sale of goods imported from the reporting enterprise and remittance of proceeds to reporting enterprise. Nothing but a dependent branch in any foreign country. Well, no dependent branch where the accounting records are not maintained in India, but they are maintained there only. But the policies will be covered by head office, right? Independent branches likewise. All the policies will be governed by the head office. Okay, it's like you will buy only from me. Okay, you will also remit all the cash to me. Okay, there is nothing that can be done without my knowledge. That's what known as integral foreign operation. Foreign operation means both are as one soul. Okay, both are living as a one soul. Okay, then non-integral foreign operation. It is a foreign operation. That's not an integral operation. It's quite simple definition, right? If every definition is like this, everybody will write it easily. The business of NFO, that's NFO, is carried on substantially independent by accumulating cash and other monetary items, incurring expenses. Everything will be done, and borrowing will also be done in local currency. Local currency means the corresponding foreign currency. And if and transactions foreign currency includes transaction reporting currency also. They can also do a transaction any currency. An example, maybe production in foreign currency out of the resource available of the country independent. Okay, it's like I will also buy from you. I will also buy from whatever from there also. I will also supply. It's like a retail outlet there. Okay, it's independent. It is independent. Not I will be empowered to make decisions, but I'm not the sole decision maker. I'm not the sole decision maker. There in before I was a sole decision maker. This head office is the sole decision maker. In before I will be I will be entitled, but I'm not the sole decision maker. The following are the indicators of the non-financial, non-integral foreign operation controlled by reporting enterprises. While the reporting enterprise may control the foreign operation, the activities are carried out without much dependence on the reporting enterprise. There's no much dependence. Okay. That is known as non-integral foreign operation. Transactions with reporting enterprise are not in high proportion of the foreign activities. For example, in IFO, I am going to supply 100% of purchase, actually substantial purchases. The 90% or above purchase will be there from the India's operation by the foreign entity. Okay, that is foreign branch. But in NIFO, I will not be much relied upon. Okay, they will get the products there depending on the demand and supply for that product. They will get there and sell it there. Okay, so it will be like very minimal interaction will be there between the head office and the branch. Activities of foreign operation are mainly financed by the operations from the local borrowings. Okay, I'm not going to finance, I'm not going to make a large investment in capital, but they themselves will arrange for some borrowings and they will finance. Okay, get it done by that way. Okay, they raise the finance independently of that head of head office. Okay, I'm not going to supply. Okay, in the case of integral foreign operation, I'm going to give the entire amount to the foreign branch. Okay, but in the case of NIFO, I'm going to just put some capital to make it that I'm the uh, owner of that particular branch, but the funds will be raised from via borrowings and not equity from me. It is like borrowings from the outside parties. Okay, foreign operation sales are mainly in the currency other than the reporting currency, which means for IFO sales will be there in either in foreign currency or the INR. Okay, but for NIFO, generally there is 90% will be in the other currency. These are the conditions. Okay, you have to check. You have to take one branch and check whether these conditions are satisfied. If all the conditions are satisfied, then you can put it as NIFO. Okay, or else you have to make it as IFO. Okay, all the expenses foreign are primarily paid in local currency and not reporting currency. Local currency here would mean the foreign currency. It is paid in USD and not in INR. Cash flow of the reporting enterprise independent of the kind of cash deficit. Okay, out of us I'm facing some cash deficit. Okay, they may enjoy some surplus. Okay, if I'm facing deficit, they are also facing deficit, then it is integral branches. Okay, and because we are one soul, right, we are one soul. Okay, but NIFO will be, they will be enjoying some surplus. They can also fund me something like that. Sales prices to foreign enterprise are not affected by day-to-day change in the exchange rate. Okay, if I'm okay, see what happens is that if I'm a head office here in India and a branch is there in say for example China, my exchange rate should not affect the sales price. Okay, if I go to that, it is what happens. It is like 100 rupees. Okay, say for example it is equal to some three some yen. Okay, the same INR will not will be different days, right? So that should not affect the price of the goods. Okay, say for example, okay, it will be best example to compare with you. Yeah, so yeah, I have say assume $1 is 80 rupees, trading at 80 rupees. Okay, if I going to price my goods at 160, okay, in US markets also, then what happens is that today one customer will come plus 22 quantities. Okay, tomorrow what happens? It suddenly falls to 75. Then they can purchase the same but with less amount of dollars, right? That should not happen. There's an active sales market for the foreign operation product. There should be active sales market. Active sales means that should not be closed down. Operation should not be closed down. It should be daily some at least one or two customers should be coming and buying the product. Okay. This is the conditions. Okay. These are indications. Okay. Indicators. Okay. Let's repeat it again. Control by enterprise. Okay. Let's make it a practice to memorize these things because It's not like it should come fast, right? That's why we memorize. Okay. Hmm? Now that we understood the concept, now we memorize these things so that it will be easy for us to write in the exams. Okay. Controlled by reporting enterprise. While the reporting enterprise may control the foreign operation, the activities of the foreign operations are independent without much dependence on the reporting enterprise. Transactions of the reporting enterprise are not high proportion of the foreign operations activities. Activities of foreign operations are mainly financed by its operations from the local borrowings. In other words, it is financed independently and is in no way dependent on reporting enterprises. Foreign operations sales are mainly in currencies other than reporting currencies. All the expenses by the foreign operations are primarily paid in local currency and not in reporting currency. Day-to-day cash flows of the reporting enterprises are independent of the foreign enterprises cash flow. Sales price of the foreign enterprise are not affected by the day-to-day changes in exchange rate of the reporting currency of the foreign operation. The sales market for the foreign operation product. Let's repeat it once again. Controlled by reporting enterprise. While the reporting enterprise may control the foreign operation, the activities of the foreign operations are carried independently without much dependence on the reporting enterprise. 2. Transactions with the reporting enterprises are not high proportion of the foreign operations activity. 3. Activities of foreign operations are mainly financed by its operations or from its local borrowings. In other words, it places finance independently and is no way dependent on the reporting enterprise. 4. Foreign operations sales are mainly in currencies other than reporting currency. 5. All the expenses by the foreign local currency and not in reporting currency. 6. Day-to-day cash flow of the reporting enterprises is independent of the foreign enterprises cash flow. 7. Sales price of the foreign enterprises are day-to-day changes in the exchange rate of the reporting currency of the foreign operation. There is an active sales market for the foreign operation product as the eighth point. Okay. Here, what we have to insist is that reporting currency is the currency in which the financial statements are being prepared. For now, understand this, it as like this. Okay. Reporting currency are as the currency. Head office financial statement is being prepared. This consolidated financial statement or head office financial statement is being prepared. For example, for a company whose head office is in India, INR will be the reporting currency, and a local currency would be for a branch which is there in USD. I mean, in China, yen will be the local currency and INR will be the reporting currency. Now, with this, we will move on to the next thing. Okay. What are the indicators now we have discussed is just an indicator and it's not a conclusive factor. Only with this, we cannot conclude that confirmly it is something. Okay. If all mentions the same way, then we can conclude. But if only something, then it will depend on the factual information situation of a particular case, and therefore judgment is necessary to determine the appropriate classifications. It is left to the management to exercise the judgment. Okay. Now, techniques for foreign currency translation. Okay. Items can be either FO and NIFO. Monetary items, closing rate. Okay. Let's see generally. Okay. Generally, let's first discuss about NIFO. Okay, NIFO, everything will be closing rate, assets closing rate. Okay, assets closing rate. Okay, monetary items closing rate, non-monetary items closing rate, inventory closing rate, everything will be closing rate. Profit and loss will be on average rate. Profit and loss will be on an average rate. Exchange difference here will be accumulated in the foreign currency translation reserve, because you are seeing it as a separate operation, right? So it will be accumulated in foreign currency translation reserve account, foreign currency translation reserve account, and and the end. Okay, and the end, because it's having a separate operation, so when we'll be also be able to sell it, right? That's why we are keeping it separately and not charging in the current year profit and loss account. I hope till now this is understood, right? For non-integral operation, everything will be in closing rate. Okay, don't think anything. Okay, as such, blindly apply it as closing rate. For revenue items, P&L items, and it will be average rate, and the exchange difference will be kept in an account named as the translation reserve account. Now, moving on to integral operation. Integral operation will be like monetary items. Monetary items means cash. Monetary items are generally those items which can be easily convertible into cash. Easily convertible into cash. Monetary means money, right? So easily convertible into cash. Monetary items closing rate. Okay. Non-monetary items, we have to take the rate as on the date of purchase. As on the date of purchase. For example, fixed asset. Okay, take for example, I have bought a land, then I have to take, okay, instead of land, let's keep it as building or some machinery. I have to take the rate as on the date of purchase. Inventory generally closing rate. Okay, generally closing rate. But if I'm having specific very few items, okay, and I'm able to track the date of its actual, I mean the rate which is available on the actual date of purchase, then that rate will be preferred. Okay, now profit and loss account for revenue items will generally be average rate, exchange difference. Since I'm very much dependent, that cannot operate without my, okay. That's why everything will be. I am going. See, it is because of my efforts this plant is surviving there. Understand in this way. If that branch is surviving due to the head office effort, then I am having a rate over that exchange difference also. Very much right over that exchange difference also. Because that is also going to be because of my efforts, right? That's why I'm charging into profit and loss account. Profit and loss account will show the financial performance. So how I am performing will be shown in my profit and loss account. That's why I'm charging into profit and loss account. But in the case of not I'm not very much involved in that operations, right? It is carrying on independently. That's why I'm keeping a separate account known as foreign reserve account. Let's repeat it again. For integral operation, monetary items closing rate, non-monetary items rate on date of purchase, inventory generally closing rate. If the actual rate on date of purchase is available, then that rate will be preferred. Profit and loss account average rate, and then the exchange current difference will be transferred to profit and loss account. Now, non-integral items, non-integral foreign operation, monetary items, non-monetary items, inventory, everything will be at closing rate. Profit and loss account items will be transferred to average rate, and the exchange difference, being an independent operation, will be transferred to an account known as foreign currency translation reserve account. Okay, let's ask, if you are asking me a question, how will I find the foreign currency? There is the exchange difference. Now we have to convert all the assets, okay, based on the rates which are applicable as per this table, and then all liabilities and equity into this rate, okay. And what we'll do is the trial balance will not tally, right, because of the foreign exchange difference. That amount which is they tally the trial balance, right? The difference will be known as exchange difference. Clear, right? Now, the last part of the session, change in classification. When there is a change in classification, the accounting treatment are ascended. What happens is that IFO is now going to become a NIFO, or NIFO is now going to become an IFO. Okay. So let's understand IFO to NIFO. Translation procedure applicable to non-integral shall be followed from the date of change. From the date of change, I will follow NIFO procedures. From the date of change, I will follow the NIFO procedures. Exchange difference arising on the transaction of non-monetary assets and the rate of reconstruction accumulated to foreign currency translation reserve account. Okay. Now what happens is that on the date, for example, 1st June, I'm going to, from 1st June, that is going to become as NIFO. Okay. Till 31st May, whatever exchange difference is there in other than non-monetary assets, assets will be charged to profit and loss accounts, and the exchange difference arising on translation with respect to the non-monetary assets will be transferred to the foreign currency translation reserve account. Hope this makes sense, right? Now, NIFO translation procedure will be applicable from the date of change, right? Integral NIFO is converted into IFO, then translation procedure is applicable to integral operation will be applied prospectively from the date of change. Translate amount of non-monetary items at the date of change is treated as historical cost. Okay, whatever the amount is there for non-monetary items, that will be treated as cost. That will be treated as cost, which means this is a deemed cost. Okay, the foreign, I mean, the INR of the converted INR rupees for non-monetary asset will be known as deemed cost. Okay, exchange difference is not to be recognized as income or expense till this. Okay, now this is the point which have to be very much focused. Okay, what we did in integral to non-integral, everything will be transferred to profit and loss account. Only in the exchange difference where for non-monetary assets will be transferred to foreign currency translation reserve account. Right now, what happens is there will be some companies, okay, just to increase their profit, what they will do for the current year, they will treat their non, okay, because it's subjective, right? So they will make it as NIFO to NIFO. NIFO to IFO. Okay. By this, what they happen is this profit this year profit will be increased. That's why there comes a check. What they say is that until the disposal, like I mean the operation is disposed, that we are sales or closure, I will not be I will not be able to, I will not be able to transfer this foreign currency translation reserve account to profit and loss account. So as long as this entity survives, I have to keep this account as foreign currency translation reserve account. But no further adjustments will be made, right? Well, the same amount will lie for years. Okay. So with this, all the concepts and branch accounts have been discussed in detail. Okay. So you can try the sums. If any sums you have any doubts, you can post it in the comments. Okay. Thank you so much. If you like this video and really find this as useful, please share with your friends. Okay. Thank you so much.